Uh, all right, we're live, guys. Portfolio talks. We're out here. I've been looking at our views on YouTube. I was sending it to Tyson. I was like, it's funny how just being consistent and showing up works because it was like the first video was like 3 views. It was probably us three, and then it
Yeah,
started like going up and up and up, and now it's in the hundreds pretty quickly, which is good. So I think people find us a little more interesting than we find ourselves, which is always an exciting thing. But the point of portfolio talks is really just to bring the conversation that a lot of people wish they had. I think time and time again, we always hear the same pain point, I suppose, with people. They're like, I wish I learned a little bit more about this and that. I wish I had this opportunity to have these kind of conversations. I wish my friends and family talked about this. No more wishing. We're bringing the conversations to you through the screen and to your fingertips. So it's let's just talk about what we're going to talk about. So how was everyone's week? Mike, Tyson, what's up?
excellent. It's getting busier. Rates are going down, so that's a great thing. We have a little more interest. People are sort of thinking about doing things with real estate, so that's fun. Um, Tyson, how about you?
Yeah, I mean, things are picking up. Things are looking good. I think we're gonna have a lot of activity in the fall, and typically, my experience as an advisor is when you try and talk to people about money and savings and changing their habits, they disappear for the summer. And we work twice as hard behind the scenes, and we get half the results. And then everybody kind of comes back to life in September, October, and that's been my experience for about the past 10 years, and I just kind of roll with it. Is I keep doing my thing, I keep working, I keep phoning people and leaving voicemails, and most of them will get back to me next month.
Yeah.
That's the summer.
Yeah,
It's
that
funny though.
is.
Like I realize it's always been the same thing. So Tyson and I, we had our team meeting. I think this week on Monday,
Yeah.
because we do it every 2 weeks. So we're talking to the team about it, and we're like, guys, don't be discouraged of the fact that no one wants to talk to you. It's just that's a cycle. That's how it's always been for me as well. Is for many years now, eons some might say. Is yeah, no one wants to talk to you in the summer. They're like, I got weddings, I got trips, my kids are bothering me 24/7. Like you're talking about money is the last thing I want to worry about right now because I'm spending it. December, same thing. Summer, same thing. So I always notice when people are have the tendency to spend their money a lot, they just don't want to talk to us because it's almost like they're cheating on us. Like, yeah, I know I'm not doing great with my money, so I don't want to like look at it. But this summer has been so busy because we made a conscious effort to focus more on our referral partnerships, our business partners like yourself, Mike, and then just events have been crazy busy this summer. For the foundation, we just put in an MRI machine into the Mission Hospital. So that was really busy. Yeah, it's been huge. So that was a big win, and it's actually I didn't realize how much work goes into it. So we were able to raise I think it was like $1.3 million to put that machine into the hospital.
Wow.
But because of that, there has to be more servers put in. There needs to be a different X-ray room. There has to be a different waiting room. So the Mission Hospital, if anyone watching this is a Mission, you'll see that the whole hospital wing is being renovated, pushing out walls, making more space, all because we had to pop that machine in there. So I can post about it on Instagram later on today, but it was crazy to see the logistics that go into it. And then the other funny thing I noticed today is the only clients that reach out to us in the summer are the ones that get pregnant. Every client that's reached out to me this summer, I'm like, hey, I want to move forward. Hey, I need to do this. Hey, I need help with finances. It's unless there's some random thing like someone bought a house, upsize, downsize. That's kind of whatever happens. But it's been 2 years now. Every summer, the clients that reach out to us are the ones that get pregnant. And they're like, hey, we need help with finances. Life's changing. So it's crazy, especially those physician self-employed clients that they're females that are going to go on mat leave, but they don't have mat leave besides EI. So it's one of those interesting things for sure. But yeah, I didn't realize it till yesterday. I got a message. I'm like, now I know. So next summer, our marketing's gonna be like, hey, so you're making a baby. Let's talk about it. It's crazy. Events wise, like how's it for you guys, Mike, in the summer? Do you do like a bunch of events? Or are you attending events? Like what does that look like for the mortgage side? Oh, your mic's not working.
Well, hang on, Mike. Your mic's not working. We're not getting any
Mike's
sound.
mic's not working. In the meantime, Tyson,
Sorry.
we'll oh
Is
no, he's
that
back,
better?
he's back. Yeah, you're good.
Um, I find a lot of people are yeah, they're definitely involved in other things. They're enjoying themselves, they're having fun. whether they're spending money or not. What I find is usually September, October, they've been hanging out with their friends who have a nice house, or they want to renovate. Like a lot of these ideas kind of come to fruition after summer, and the kids are back in school or whatever. But yeah, it's a common theme. And you know what, I actually had a topic I wanted to ask you guys about, because it's one of those things that most people have heard the word, but they don't really understand it. Um, we have life insurance and we have disability insurance. Those are fairly straightforward, but what's the other one? What's the other one that we always talk about or should talk about?
Yeah, probably critical illness.
Yeah, exactly. That's what I was gonna. That and disability are less known than obviously life. I mean, it's pretty straightforward, but I almost think the other two are almost more important in some ways. Tell us, like, as average Canadians don't get told any of this stuff, so
Yeah.
I find it's understood. So I'd love to hear you guys take on it.
You want to kick it
Go ahead,
off, or you want
Tyson.
me to? Okay.
No, go ahead.
It, the way that I kind of tell the story is it used to be in the 80s and 90s, before critical illness insurance came out. If a medical professional says the word cancer to you, it was pretty much a terminal diagnosis. And life insurance would take care of that and will take care of your family. Don't worry about that. But this is 2024. Having cancer is like super common now. And unfortunately, it's such a common event and it's very survivable. And so life insurance pays you when you pass away and you leave responsibilities, you leave family members. Critical illness insurance is like for what happens when you survive it. You're probably going to need 24 to 36 months of recovery, depending on the type of cancer, the surgery you have, the facilities you have. And so what this really does is it's going to provide you with a tax-free lump sum of money so that you can do something with it. And so, you can take your kids to California and go to Disneyland if you think this is going to be your last like family trip. You can travel to another country to see the best surgeon in the world if that's something that needs to be done. This is not financial advice, but I had somebody that I work with. He had a massive heart attack, and they thought like this is really serious. And then 2 weeks later, he was totally fine. He bought a Mercedes with his critical illness payout, and so that's not what you should do.
No.
But it's your money. It's tax free. It's in your bank account. You decide what you want to do with it. Um, and then critical illness insurance, it covers like 26 different things. Every company has slightly different definitions, but essentially it's heart attack, cancer, stroke, organ failure, and then a myriad of other things. Um, One area that Vishal and I really see the importance of this is children's critical illness. And it's such a weird thing to think about, but children are very resilient in that they're highly likely to recover from whatever serious
Right.
illness that they have, but it's not for the kids to pad their bank accounts or whatever, but more likely if your child is diagnosed with something, you're not working. Like you're in the hospital with
Right.
them, you're on every appointment, you're flying with them, you're seeing specialists, and if that's 2 years, that's 2 years of income that you as a parent don't have. And so that's kind of how I frame it for my clients is it's important for those reasons. It's not that it's not a path to wealth, but more it's like income protection, and it allows you to, invest in your health if you go off track, you can see the best people.
And at the most stressful moment in your life,
Yeah,
right? I
it's
mean,
the worst time of your life. Yeah.
yeah.
Yeah, I think that was really well said. The thing that I really want to hammer home, and I'll look right into the camera for this, is no one else is going to take care of you and your family besides you. It's not going to be the government. It may or not be your family, and we hear that one a lot of people like, "Oh, my family will take care of me." You don't know what the situation is going to be with your family later on. Maybe they, don't get along anymore. Maybe they have their own health issues. Maybe all their money's tied into real estate, and the market changes. No one is going to take care of you besides you. Not your friends and family, not the government, not GoFundMe, no one else but you. So the way I look at critical illness and disability insurance and life insurance is for the most part, all of them are important, not all of them are urgent. So eventually you should have a diversified portfolio of all your insurance because you don't know what's going to happen to you. You don't know what kind of risk is going to derail the trajectory of your wealth accumulation. It could be a prolonged disability. It could be a critical illness like Tyson spoke about that can knock you out for a couple of years or forever change your ability to earn income depending what your profession is. Or it could be you pass away and now you're leaving your spouse or kids with all the debt that you accumulated during your lifetime while you're trying to build your wealth, but now without your income, which can be honestly, it can cripple generations, or it can put you in the driver's seat of making generational wealth. So life insurance, I think, Mike, to your point, everyone knows about life insurance. It's pretty straightforward. If I pass away, money comes in to my beneficiaries, and there's a bunch of different ways you can build life insurance. But I think that's really well known, and companies that are out there, recruiting and things like that, do a good job talking about life insurance, and that's like their main bread and butter. But the thing that's the most misunderstood is disability that's not provided from your employer, and then critical illness. So with disability insurance, it's pretty straightforward. It's dependent on your inability to work. So whatever your profession is, when you're watching this video, there is a way for you to get disability insurance. There is someone out there that will take on the risk of if you get injured and you can't work, we'll help you pay your bills to make ends meet. What you shouldn't do is get the most amount of disability insurance that you can get approved for. Instead, what you should do is look at your fixed expenses. So how much money do you need to make ends meet? Your mortgage bills, your hydro, your cell phones, car payments, things like that. Get that amount of disability insurance in place. And if you're certain professions like our physician clients, dentist clients, things like that, you can get something called a future income option, which means that as your income, but also as your expenses increase over the time, you can also increase your disability insurance to keep up with your cost of living without having to do medical underwriting over and over and over again. You just show your tax docs, hey, my income has gone up, and they can bump up your coverage as well. So that's disability insurance. A lot of people think like I'm good, my employer covers me. What we saw during COVID was when employers need to make ends meet because their revenue is down, there's a couple ways that they'll do that, and the number one way they'll do that is reducing staff or what they give to staff. So we saw during COVID a lot of group benefits get changed because they are not guaranteed. Your employer owns it, they can make changes to it, and they can do whatever they want to it. So if they need to cut costs, they're going to cut costs on that, pension matching, or they might just lay you off entirely. In either instance, you're not going to have disability insurance anymore. So your employer, if you're going to be a career employee, that might be fine for you to have group benefits that include disability. But if you're someone who is going to be a job hopper, if that's a word, or if you're going to be self-employed eventually, then you might want to look into getting your own disability insurance because as your cost of living goes up, what would be the impact if you had no income anymore? And that's what disability insurance covers. And then for critical illness, I think Tyson said it perfectly. There's a lot of things that are unrealized costs when you get ill. If you have cancer, heart attack, stroke, loss of your limbs, whatever that may be, Alzheimer's, dementia. There's so many things that you will never realize that you need, and the government's not going to support you with that costs a ton of money, and that's where critical illness steps in. And we tell this all the time to our wealth accumulation clients. As you're building your wealth, if you get ill, that's going to stop. You thought you were going to be able to save it for a down payment, that's gone. You thought you were going to be able to start your own business, that's gone too. You thought you were going to be able to retire on time, unfortunately, that's gone as well. So there's a lot of things that can be negatively impacted by getting an illness. Critical illness can prevent all that by giving you a large cash injection. And like Tyson said, it's tax free, so you can do whatever you want with it. Obviously, your financial planners will help you make the best decision possible, but it's your money. So if you want to buy a Mercedes, I guess you can. We can't really stop you. Um, that's one thing. And then the really interesting thing about Canada. So if you're watching this and you're Canadian, the really interesting thing about critical illness is there are side benefits of our critical illness policies that are available here in Canada that are not available in the States, that are not available in the UK, because our product is so new, because Canada is so new, they haven't got rid of them yet. So if you take your actuarial hat and put it on, and by that I mean like the numbers and the metrics behind critical illness, in other countries, cancer rates themselves are extremely high, 50, 60% for breast cancer, for prostate cancer. So cancer rates are very high. So the probability of it paying out are astronomically high. So in Canada, you have options where best case scenario, if you never get ill, you can cancel your critical illness policy and get all your money back tax free. So think of it like a forced savings account or like a bond is you have that capital preservation. So if you make your payments for 15 years and after 15 years you never got ill, you can be like, hey, Tyson, hey, Vishal, I don't need this anymore. And, I want to cancel this policy. You can cancel it, get all your money back tax free, and you can buy an investment property with it. Go see Mike, get a nice place in Kelowna. Or you can, help fund your kid's business or supplement your retirement or help their education. Whatever you want to do, it's your money. And that's the best case scenario. Worst case scenario, if you get critically ill, you get a large injection of cash, 100, 200, $300,000, and you can do whatever you need to do with that money to make sure that you retire on track, your kids are supported. Because one thing we always tell our clients is when they have kids, people are so quick to plan for their children, but one of the best things you can do for your children is to not be financially dependent on them. You can cripple them because you think cost of living is expensive now. Just wait till your kids get older. So one of the worst things you can do, in my opinion, as a parent, is be financially dependent on your children. Instead, make sure you take care of yourself first. Make sure you're good, your retirement's good, your critical illness is good, all the stuff is taken care of. So if you were to get ill, worst case scenario, you can still support and take care of yourself instead of being like, I'm done, and you need everything on your kids because who knows what they're going to be in life? Who knows if they're going to want to take care of you? Who knows if they're going to pack up and move to Dubai or whatever, right? So it's very, very important. And that's a lot of the reasons why I think critical illness and disability insurance is so important because it's going to protect you, your kids, and the entire goal of your life. So long-winded answer, but I'm very passionate about insurance, as you can tell.
No, I love, what's fascinating is it's a conversation most people kind of ignore or shun or don't want to talk about in general. But it's so important, like you said. I mean, it's as important as it might be sexy to talk about investment, but it's actually just as sexy to talk about this stuff because, for example, self-employed people, sometimes they won't qualify under government stuff because they're still capable of working if they're, sitting in a chair working.
That's right.
Oh, so what if you're disabled? Like, but if you guys have that conversation, you can explore that and look at different options that people aren't even aware that are out there. And that's, I know it's not like summer chat stuff necessarily, but it should be because it's something I find most clients just put it off. Yeah, we'll get to that. And then it's one of those things that never gets set up. So,
Yeah.
yeah, I think it's so important, and there's so many pieces to it that a really thorough discussion are needed. And like you said, I mean, it's important to help your kids, but it's also important to be not a drain on them down the road. I think that's so smart.
Yeah.
So
In an emergency on the airplane, you put your mask on first, right?
yeah, yeah,
And that it's the same thing.
yeah.
100%. Tyson made it a summer talk because we talked about only people that talk to us are the ones that have kids, and he talked about child critical illness. So smart man. He tied it into the summer chat.
Um,
um, on topics, there's one topic that a client asked me about, which I think is just as misunderstood as critical illness and disability, and it's in your wheelhouse, Mike. So, reverse mortgages.
mm,
It's one of those things that people hear kicked around, but no one knows what the heck it is. So let us know. Reverse mortgage, who's
sure.
it for? How does it work? What's the rundown on it?
Yeah, they came out about 30 years ago in the UK and the US, and those were terrible. And unfortunately, they've kind of got that stigma attached to them still. The ones in Canada are not like that. They could take somebody's house away. There's horrible, horrible pieces to that. The ones in Canada are not like that at all. They're all federally regulated. There's nobody losing their house over it. And in general, it's more and more prevalent because we have these boomers that are, hitting the older ages, and they're sitting in a house that's $2 million in value. They may not owe anything, or they might owe a small amount, just depends. But they're almost like living on dog food because they have no, like, their pensions are just not covering the real cost of life, and it's so sad. And I think, yeah, in an ideal world, people have met with you when they're 20 and they put all their money away and they were planning all the way, and they've done very well and they don't need any extra income. But there's so many out there that they're sitting on a lot of equity. If they walk in the Royal Bank, they can't get a mortgage because they don't have the income. And the rule changes in the last 5 or 10 years have made it so that they can't, like what they used to be able to do. And so these reverse mortgages, what they are basically is you can choose a lump sum or you can choose actually a monthly payment. And you set up how much it's there. It's based on the amount of equity you have and your age. It's not based on your income. So the nice thing is that, I look at it this way. if you're healthy and you're in your 60s and you've got kids and your house is paid off, um, in that scenario, maybe you don't need to live off it, but maybe you can help your kids now as opposed to waiting until you're not there anymore. Maybe they borrow 2 or 300,000 and they either help their kids with the down payment, or imagine having a life altering trip or something with your kids and having an amazing experience that you may not be able to do down the road when your health isn't as good. So those kind of lifetime experiences, rather than just sitting on an equity situation and not doing anything until you're gone, your kids would probably rather have that life experience with you. And in the big scheme of things, on a $2 million house, 300,000, where you don't have to make any payments on it, yeah, your kids are going to get slightly less down the road, but you also had a life experience with them earlier on. So it's a very interesting discussion that's needed. It's not for everybody. I don't say that it's for everybody, but for the right people, it could be life changing. And if it means that they could have a $3,000 or $4,000 income for the next 5 years, that could change how they live too. And really, I mean, if you look at real estate, it goes up and down, but over time it slowly goes upwards. And when we're talking about, also the other side of that is people can stay in their home, that they may not want to move, they may not want to downsize or change, and it enables people to do that too, and possibly renovations that'll enable them to live in that house comfortably as opposed to going up and downstairs maybe or something. So
Yeah.
there's a lot of reasons why people should have the discussion, but I'm sad that there's a stigmatism attached to it. There's just the knowledge is lacking. They hear the word and they just instantly think that's bad, bad, bad. And like I said, it's not for everybody, but it's so important for the right people. And it can just change people's lives. And that's why I'm trying to get the message out to people, but it's hard. And I know that you guys probably see the chip bank. They do a lot of ads on stuff, but and that's good, but it doesn't explain things very well. It just sort of gives them a tip of the iceberg. And yeah, I'm very open to having chats with people. In fact, I encourage the kids to talk to us, and before the parents do, and then have a discussion with all of us. And how is it going to impact the kids? How is it going to impact their parents? And it doesn't make sense for them. And sometimes it won't make sense, but for some, it's a huge change in their lives, and they can actually enjoy themselves with their kids while they're around.
Yeah, that's a huge thing.
Yeah,
Something that we see with the older demographic is I don't think they realize how soon they're gonna stop traveling. It's like you
yeah,
retire and then everything's great and it's like you're young again and you party and then very quickly, it might be 8 years, it might be 10 years, you
yeah,
don't want to travel anymore.
yeah, yeah. And in this world of, well, I mean, not even talking about politically, but just like medical and all the, why do you want to be somewhere other than Canada? It's dangerous and for some people. And yeah, you're right. I mean, not a huge window that they have to enjoy themselves with their kids as
Yeah,
much. So yeah,
interesting.
yeah.
I
It's
guess
interesting to. Oh, sorry. Go ahead.
to follow up on that, sorry, Vishal. Um, in your opinion, what's the difference between doing like a reverse mortgage and doing like a home equity line of credit where you kind of control the flow? Like, how does that, how do you see it
Yeah,
fitting differently for people?
it's I think the a HELOC or a line of credit on your home can do a similar thing, but you still have to qualify for that. So what I
Yeah.
kind of recommend to people is when they're still working, maybe in their 50s, that's the time to set up that HELOC. And they may not need it now, but the best time to get credits when you don't need it.
Yes.
And kind of have it in place so that when you do retire, you have those funds available. They're cheaper than a reverse mortgage. So in a perfect scenario, you're in your 50s, you set up the HELOC on your house, you don't use it, or you have a small balance and you pay that off while you're working. When you retire, it's there, you can keep using it. And then, eventually you may convert that into a reverse mortgage because you don't want to make any payments on it anymore. So yeah, we do look at that as sort of a stepping stone. Um, on HELOCs, you still have to make an interest payment. So if you owe $300,000, you're going to pay, depending on what prime is, you're going to be paying $1,000 a month or more. And at first that might seem fine, but after a while it might become a drain on their income. So that's when we would look at converting it and moving into a reverse situation. Because I think like the depression era kids grew up, you've got to pay your house off, you've got to pay your house off. And when your house was $5,000, yeah, I mean, it was potentially possible, and it's less and less possible now for newer generations. So I think there's also a thing where, yeah, like it's okay to go into retirement with a small mortgage, but let's think about how we want that. Like set it up on a HELOC so that it's just interest only, or even potentially a reverse mortgage. So there's a lot of strategy to that, and it's definitely worth a discussion earlier than later. Just like with you guys, I mean, it's better to have a plan for the next 10 or 20 years as opposed to next year. So
Yeah.
yeah, it's always it's everybody's situation slightly different, and it just depends on where they're at and what we can qualify them for, and that kind of thing.
Interesting.
It's interesting the similarities between the reverse mortgage and critical illness, and the things that they can do. Like you talked about the reverse mortgage, how it can allow you to take end of life trips and things like that, and that's the same thing critical illness can do. And we've actually had like the one thing I love about critical or reverse mortgage is giving them an income, kind of like an annuity. And I had a client who had critical illness; they were diagnosed with cancer, and when it paid out, they needed some extra income because they were working in the trades, so they
Right.
couldn't really go to work for a significant amount of time. So they're probably working a quarter of the time they did before. So supplement that income, we just took the critical illness payout and put that into an annuity, and that paid them a fixed income that made
Right.
up for their lost income as well. So there's so many different ways. I think that's one thing for everyone to take away. There's so many different ways to get to an end goal. As always, the earlier you plan, the better. I love that line, Mike, where the best time to get a line of credit or credit is when you don't need it, and that's so
Yeah.
true. Like I remember when I got my first place, I should have got approved before I left my employer, but I didn't. I was like, yeah, screw this job, I'm out of here, and I left. And then I was like, oh man, I should have I should have got approved when
Yeah.
I was there. Now I gotta wait or do private. So I learned that very, very early in my self-employed career. So I think that's really well said. Is the best time to get credits when you don't need it. So just have the mechanism there as long as you're disciplined enough not to tap into it to put your Cactus Club dinners
Yeah.
on your line of credit or Aritzia shopping or whatever that may be. So long as you're disciplined, I think you should get pre-approved for some stuff. I just, especially when the banks are trying to give it away desperately, like I can't even, I got stacks of mail just sitting there, like you've been pre-approved, MasterCard, Visa, Amex, TD line of credits, like everyone's pre-approving you for everything. So if you're
And
thinking
why
that
is
when
that,
rates
Michelle?
drop,
Why do you think they're doing that?
money makes the world go around, man. So
Yeah.
it's just one of those things. They know that a lot of Canadians have been conditioned to live off credit and live above their means, and the only way you can supplement that is by using credit, and they make a lot of money on credit. So
Yeah.
if you're someone who is not in that situation where you are disciplined with your credit, where you don't really use it, but you want to leverage it to grow. For example, you want to start your small business or you want to inject more money into your small business, getting pre-approved for line of credits could be a smart move now and not use it until rates go down. And when rates go down, hey, I'm gonna hire a VA. Cool.
Yeah.
You can use that to float your money. Hey, I'm gonna buy some new equipment that I can cash flow positive in like 9 to 12 months. Cool. Put that on line of credit and you'll break even. There's a lot of different ways that credit can help you, but there's a lot of way the credit can hurt you as well.
Yeah.
So of course, having a plan in place is very important. But yeah, it's just there's so many things out there, which Tyson and I talk about this all the time with some of our clients, where like a lot of people get paralysis by analysis because there's so much information out there and they don't know how to decipher out of all these options available what makes the most sense for me to get to this goal in front of me. And that's where we specialize is cutting away the noise and be like, hey, like for you, out of all these 7 options, we eliminated these 6. This one makes the most sense for you because X, Y, Z reason, and this is how you implement it. So, and we utilize people like yourselves all the time, where it's like we may seem like we're smart with everything, but behind the door, I'm like, yeah, sounds good. Hang up, call Mike. Like, Mike, man, help me. What does this mean?
Yeah. No, and I think that all points to having expert advice and a plan. If you can have your own plan and that's fine. And obviously with Googling and the internet, people can come up with their own plans, but it's dangerous because you're relying on advice that you don't even know where that's coming from, or you don't know who's talking about it. And even if it's Canadian advice or American advice, or I mean, scenarios can change a lot if you're in BC or Alberta, let alone where you are in the province. And it's also about what you want to do. So I mean, there's so many pieces of those puzzles that I'm such a big believer in getting the right experts to help you with the advice and move on from there. Like, don't be afraid to build a plan, and it might change. 3 years from now, the plan could be completely different. That's okay. But the best time to start is right now,
Yeah.
and start with the baby steps and then work towards the
Yeah.
big stuff.
Yeah. I think a challenge a lot of people have mentally with planning is schools condition people to not make mistakes.
Hmm.
And so when they're trying to build their life plan or their
Yeah,
retirement plan or whatever, they want to plan it perfectly when nothing ever goes perfect. And like we're all self-employed business people. Every plan that we ever have blows up in our face, never works exactly like we think it's
yeah,
going to. And at first it's frustrating, and then it's kind of funny.
yeah,
Because you just know, I lined everything up, I've ticked all the boxes, and then when you start, it's like nothing works, like my microphone doesn't work, my camera doesn't work the other
yeah.
day, nothing, like things just don't work the way that they're supposed to. And I think that prevents a lot of people from starting the planning process and engaging professionals like you.
Yeah. Paralysis by analysis, right? Like
Yeah.
Yeah.
you're better to start some kind of plan than have the perfect plan. You'll never
Yes.
like the plan's never going to be perfect. It's always adjusting and just like life. And but you learn from it. And I think that's the key. Next time you check your mic before you get on the call, right?
100%. I think it's funny you're talking about like be careful where you get your advice. I think that's very true for online, like social media stuff like that, but it's also true when it comes to the professionals that you work with. So like you allude to experts, plural. Nowadays, I think you see a lot of people that try and be everything in one person. Like, you'll see people that's like, oh, I'm a financial planner, I'm a mortgage broker, I'm an insurance agent, I'm a realtor, and I'm your personal assistant, everything all in one. And you're like, if you think
So
about it
true.
logically for a second, there's no way that you can be like my broker, my planner, my insurance advisor. It's impossible. Like, you
Yeah.
can't do it as a one man, one woman shop. I get why people do it because they're trying to make the most amount of money like per client. Life's expensive, Lower Mainland's expensive, Toronto's really expensive. So I get it. That being said, from a client perspective, if you take a second and think about it, like how can someone be an expert in everything? Like I would never trades. I would never have someone come to my house and be like, "Oh, okay, cool. I want to renovate my place." Yeah, yeah, you're in luck because I'm the plumber, I'm the electrician, and I'm the framer. I'm like, what? Like,
And I'm
how
a
are you? How
doctor.
are you yeah, I'm your doctor, by the way. You need any blood work done right now? I can
Yeah.
do it right now. I'm like, what is going on? So it's important that you look at, building experts, plural, people you trust, people you can listen to, who are just genuine, because a lot of times we know a lot of the same stuff, but it depends your approach, your process of how you articulate the information, your system of working with clients, all that kind of stuff is what differentiates you. But having experts, plural, is super important instead of having, this one person that's a jack of all trade, master of none. You're for sure going to be getting subpar information in all different disciplines as opposed to just having, experts in their specific fields.
And just sorry, Tyson, but the big piece that's in there too is understand what your expert's motivation is.
Yeah.
If they're motivated to help you in a long-term plan, that's much more important than just selling you one thing.
Yes.
If their focus is just getting you into whatever it is you're talking about, that's a dangerous situation. You don't want to necessarily take that with a grain of salt. And it doesn't mean that they're all wrong. It means like understanding, okay, this person is after this one product and that's all they're thinking about, as opposed to somebody who's talking to me about where I should be in 20 years or 30 years. And that's that's a big thing, a red flag I like to use too, because if you're truly in this for the long term, you're going to help your clients the right way. And
Yeah.
if you're not in it for the long term, it's going to show up somewhere.
Yeah, yeah.
Hundred
I've been around long enough that I've seen, the hot advisor come in and, whip up a storm and win all kinds of sales awards, and then in 5 years they're gone.
Yeah. It's
And
called
then
the
you,
Ponzi scheme.
right, oh, just about, yeah.
percent.
And then, like these seasoned advisors that are just kind of like slow and steady and been here for a long time, we inherit those clients. You look at the file and you go, "Well, how did any of this pass compliance? How did it
Yeah.
get past the clients? Like what is happening?" And then you have to go and like, fix it. And it's terrible. And then you have a process of kind of like apologizing to the client, educating, going like this is what should happen. And so part of our approach, like Vishal and I take, is a lot of upfront education and disclosure to the clients, and especially when we take over from like another company, clients got
Yeah.
stuff. Just about every client's got stuff. You say this is what this means, and this is like why the advisor did that. Like Did you get any service? This is how much commission that advisor made for doing X. Vishal and I were just looking at an investment statement the other day and did set the client up, and it looks good in like a short-term deal because investment returns were excellent last year.
Right.
We don't know what it's going to look like in the next 2 or 3 years, but the way that they did it, they got all their commission up front, and and so will that advisor be here in 5 years? We don't know.
Yeah. Yeah.
And Tyson, you want actually just, I think that's a good point that you brought up. You want to just talk about the downside, like what you were saying about the downside of that 5 year one is. So, for example, if another advisor wants to work on them.
Yeah, and so how this one was set up is on the insurance side, we have something called segregated funds, and they're just like a mutual fund done through an insurance wrapper. You can get a few different guarantees and benefits with it. But the investment regulation is further ahead than the insurance regulation. And so in the insurance side, they're about 5 years behind. So they haven't eliminated commissions and stuff yet. So there's something on there. It's called the chargeback 5 option. It replaced the DSC, or the deferred sales charge model. So the client enters into this portfolio, buys the investments, and they're not locked in. The client is not required to do anything. There's no penalty if they want to get out, but there is a penalty to the advisor. And so on this chargeback model, if the client takes money out, which is very common, then the advisor has to pay back part of their commission as a chargeback. So Vishal and I were working with another advisor, and we cautioned the advisor, like, hey, if the client wants to work with you, you can't take over this account and just become the advisor within their portfolio, because any changes that you make, the new advisor receives the chargeback, not the old advisor that sold it. And it's a kind of a weird model, and I think the insurance regulations will catch up with it. But again, they're like 5 years behind. And so we might not see reform on that for till 2028, 2030. That's a long time. And so there's all kinds of like these little like gotchas and landmines that are in the portfolio.
Yeah.
The good news is it's not a gotcha on the client, but it is a gotcha on the advisor.
I think what that really points out is when we're talking about who you select as an expert or an advisor, if they're educating you, they're probably pretty good, because if they're educating you and they're not afraid to say this is what that is, and explaining it, an educated client can make way better decisions than somebody who's just hoping it's the right move.
Yeah.
And I think truly long-term advisors take that kind of an approach, because you want your clients to understand why you are selecting or choosing that for them, but you also want them making the decision from an educated point of view, so they know what's going on. It's so often when you see some of these players, it's very kind of, oh, it'll all go great, don't worry about it, like don't look too close, just sign here and let's go. And I mean, we've all seen those people in various different places, but I think that's a red flag as well. Like, if somebody's in this for the long term and they're explaining how all the charges work, or what's the downside, like if you're talking just upside, there's also a downside. And
Yeah.
if you're not thoroughly explaining that to clients, you're not doing your job. So that's a big piece too, I think.
Yeah, I think so too.
In a weird way, it is a gotcha for the client though. Like I would say there is a gotcha on the client, because when you look at that portfolio, the first thing that stood out to me, it was over diversified, where it had like a $15,000 account or portfolio here, then there's a $20,000 portfolio, then 30,000 portfolio, then 20,000 portfolio. So what that points to is the advisor that originally did it, instead of just like, oh, you got some more money to pop in, just pop into your existing portfolio, they wanted the commission, so they open up another portfolio
Oh,
that's invested differently. So that's why they have like, when I looked at it, I'm like, it's weird. They had like a, I think 9 different portfolios for all like weird, obscure, small amounts. And then we looked at the commission structure, like, that makes sense. That's why they did it. They just wanted to make as much commission as possible. So they broke it into different ones. And we asked the client, like, what do you like about your portfolio? They're like, oh, yeah, it's diversified really well. But they don't know that. It's like, okay, well, you were told that. And that's why the advisor's like, oh, we're doing it this way because we want to diversify you. It's invested in the same things, but he just made so many different sub accounts, so that he's making more commission. And then it's a gotcha for the client again, because that advisor obviously not doing well for the client, obviously not educating the client. the fact that they're looking elsewhere. So when they're looking elsewhere, it's hard for the other advisor to come in and do the work because you're basically saying, hey, I made none of the money, but I'm going to take the penalty to rebalance your portfolio to how it should
Right.
be. But they're obviously not going to do that. Like it's not feasible for you to start taking hits for everything of just rebalancing clients. So then you're going to sit there and wait for the 5 years to run out before you rebalance it. And what kind of losses happen in those 5 years or potential missed gains, right? So it's such a weird thing that commission and the way people make money can impact so many different people. But that was the weirdest thing when I looked at the portfolio. I'm like, well, why is there so many accounts here? And then we're like, oh, okay, that makes sense.
We have something similar on the mortgage side. A lot of the banks now will set up these limits and then, oh, you want a car? Let's put it on your mortgage. And then you end up with like 6 different mortgage accounts. Well, why is that? It's not good for the client, but it's great for the bank because you're all different times, so you can never line it all up. And I'm
Yeah,
always a huge believer in having one payment because then you can focus on paying that down. If you've got 6 different payments, how can you focus? You can't. And one's got this rate, one's got that rate, one's 2 years and one's 4 years, and it's all over the place. It's purposely complicated, just like that, that the client ends up saying, I don't know what to do with this, and they just leave it. And that's what the bank wants.
yeah.
They don't want to lose that mortgage, so they've got it split up in pieces. So yeah,
And the
very
bank
it's
only
it's
hits you back with
similar.
like, we can roll over debt when the interest rates are high. It's like, oh, we can roll over debt. Like that's all the mail I was getting. It's like, do you have any debt to roll over? Visa, we'll take care of it. Like, no, you
Yeah.
won't. Shut up. Like you're trying
Yeah.
to get 20% interest rates.
And we'll increase your credit card limit.
There you go. There you go. So yeah, careful. These guys are like loan sharks. They're like payday loans. Maybe we'll talk about payday loans next week, but
Yeah.
it's a crazy thing. But I think we're good for time here, gentlemen. So yeah, honestly, great conversation. A lot of stuff we talked about: critical illness, disability, reverse mortgages, um, unethical advisors and salespeople, I suppose, is one thing we talked about as well. That was just kind of random. Well,
Yeah.
I think this whole conversation is random. We don't really plan it. We just pop on here and start
No.
talking. So that's one of my favorite things about it. But as always, if you guys want to be part of the conversation, the rooms that you wish you could be a part of, we're bringing it to you through your screen, to your fingertips. So as always, make sure that you tune in. This is done every Wednesday. So soon enough, we'll start creating a mechanism for you to ask questions and send it to us, and we can chat about those as well. As of right now, we've got a backlog of stuff that we probably should be talking about. So we're just going to rip through this stuff that people have been asking us about, and then we'll start taking more questions, or else we'll never get through our long, long to-do list. So thank you for joining us, everyone. Thanks, Mike. Thanks, Tyson. And thanks myself, I suppose. Let's get off the day, and I'm sure I'll talk to both of you guys in like 20,
And
30
please
minutes
click and
here.
subscribe.
Click and subscribe, share with a friend, share with your family, share with everyone.
Yeah. Thank you.
Awesome. Thanks,
All right.
guys.